Hello and welcome to CNBC TV18's Mumbai Newsroom. I'm Sumaira Abdi and you're watching MF Corner. Joining in today to answer queries sent in by our viewers, we have Anand Dalmia, who's co-founder and chief business officer at FISDOM, and Shweta Rajani, senior vice president and head of mutual funds at Anand Rathi Wealth. They'll be answering all our queries which have been sent in by our viewers. So good afternoon and thank you very much, Anand and Shweta, for joining in today. The first query that we have is coming in from Ganesh Masurkar, and he says that he is currently restructuring the mutual fund portfolio, and he wants suggestions on whether he can start a monthly SIP in the following funds: Canara Robeco Blue Chip, Mirae Asset Emerging Blue Chip, SBI Small Cap. Then there is the Parag Parikh Flexi Cap. And if this selection is not fine, then he wants to know if you can suggest alternate funds that he can invest in. He's looking at decent returns amidst the current market volatility. The other details that he has sent in is that he has enough retirement savings but wants to build on the corpus at the moment. So, first things, Ganesh, is if you're looking to restructure, we would have liked to know details of what you already have. In the absence of that, all our experts can do is just give an objective opinion on the 4 funds that you have selected. So, Shweta, these 4 funds, they pass muster?
Hi, Ganesh. SIP, one thing is a good way to bring in a disciplined approach to your investment. So that's, thumbs up to you that if you have any extra corpus, you've thought of doing an SIP. Now we've done one study which, there are different categories of mutual fund like large cap, mid cap, small cap. We did the study and it shows that there are certain categories of mutual funds which have a better alpha potential when you're doing your SIPs, as well as the rupee cost average benefit works the most in these specific categories. So it helps you bring down volatility of the portfolio as well as give you that extra return. And these are primarily the small cap and the mid cap categories, whereas a large cap as a category has the least potential on a relative basis. So within the 4 schemes that you mentioned, I would say SBI Small Cap definitely is a good fund and you can continue your SIP in that. Mirae Asset Emerging also has a component of mid cap in the portfolio, and that's been a steady performer with good fund manager ranking as well. So that's another fund which you can continue for your SIP investments. The other 2 funds that you mentioned, Canara Blue Chip and Parag Parikh Flexi Cap, I would say instead of these 2 funds, you can look at a Kotak Emerging Equity. That's a mid-cap fund, and again, one of the top-rated mid-cap funds consistently over the last few years. The 4th fund, I would say, if you want a Flexi Cap fund, then HDFC Flexi Cap is the 4th recommendation that I would give you.
Okay. The next query that we have is coming to us from Bhopal. Zaid Siddiqui has written in. He says that he has made investments in his portfolio. The funds that he has are Mirae Asset Emerging Fund, there's Axis Growth Opportunity, Edelweiss Balanced Advantage Fund. So those are the 3. He wants to know whether to remain invested or, redeem and reinvest in the other alternative funds which you may suggest. So again, we don't have the full portfolio or goals, etc. But nevertheless, Anand, your opinion on the 3 funds selected?
Sumaira, as you rightly pointed out, one needs to understand the goal, the tenure that he has left to achieve that goal, as well as the risk profile. But in the absence of that, I would say all the 3 funds have a stellar reputation and a consistent track record. So, well done in selecting the right funds. Just at a high level, seeing these 3 funds and not being aware of if you hold anything else, these 3 funds, I would say, are largely, large cap focused. And, given that you only have one balanced advantage fund, your allocation to debt will be pretty low, given that it's 1/3, assuming again, it's 1/3 each of these funds. And I don't see any international exposure. So, I would say if you're looking for a higher return, maybe you should move a bit towards the mid cap and small cap funds if you have a longer tenure and you're you have a risk profile which is aggressive. And you can look to add some international exposure to your portfolio as well.
Okay, up next we have an interesting query that has come in to us. Nitish Kumar from Bengaluru has written in. He wants to know if it is necessary to build a tactical portfolio. If yes, he wants to know how to build it and what is it used for. So for those who are watching may not know, you have one which is a core portfolio, right, which you use as the mainstay of your investment life, which is used for long-term wealth creation. And a tactical portfolio is something that you may use on and off to take advantage of market timing. Shweta, is a tactical portfolio a necessity for every kind of investor, or is it more suitable for the savvier investors who may actually know how to make use of these tactical calls or market timings? What would you recommend that our viewer do?
Sure, Samira. Hi, Nitish. And like Samira, mentioned, there is a tactical portfolio and there is a core portfolio, which we also call as a strategic portfolio, strategic allocation to the portfolio. But Nitish, before I get on to explaining importance of tactical or a strategic portfolio, I'm going to take a step back and explain that the entire process first starts with you defining your objective. And when I say objective, I mean you should have your return objective in place, your risk objective in place, as well as define an investment horizon for which you're targeting that return and risk objective. Very simply, let's say you're targeting a 12% return over the next 10 years at a risk level which could be 7 to 8% deviation from this 12% return is something that you're okay with. If that's your objective, then the next step is defining what allocation would help you best meet this objectives. And that is what we call as your strategic allocation or strategic portfolio. Here, the two important decisions that you take is your asset allocation. So, you may be wanting to have a 65% equity and 35% debt to meet this return objective. And within those asset allocations, what kind of instruments do you want to have in your portfolio, which will help you achieve this long-term goal? Now, the advantages of having a strategic allocation in place is that every decision that you take would be taken considering whether it will help you meet your objective or no. It will help you avoid taking emotional decisions. It will help you avoid taking short-term decisions which would be made basis what the current market scenario is. So you must have a strategic allocation for your portfolio. Coming to your question of whether a tactical allocation is needed and what is it exactly. So tactical allocation is something where you're taking short-term calls because the current market environment is suggesting that a certain asset class may do well or a certain product category may do better than the others. So your decision is not basis whether it helps you meet your overall risk or return, but it's more to do with, in this scenario, is this likely to do better? So, to give you an example here, you may have chosen to have equity mutual funds in your portfolio, and therefore you've made a mix of large cap, mid cap, small cap funds. But a tactical call would be that you're expecting IT sector to do well or banking sector to do well. So you're adding a banking or an IT fund in your portfolio. Now, the benefit is that these tactical calls may give you short-term supernormal returns. The downside of this, or something that you need to be cautious about, is timing becomes very critical. So you need to know when to exit, after you've made decent returns from this. Because if you don't actively monitor your tactical portion of the portfolio and take those entry and exit calls, instead of making supernormal returns, you could actually, end up making similar normal returns as your strategic allocation, or in fact, not make significant returns. So therefore, I would say you can avoid tactical allocations in your portfolio if you're not, monitoring markets and your portfolio on a frequent basis, but have a strategic allocation in your portfolio once you've identified your return and risk objective.
Yes, absolutely, Shweta. And, just for me to add, like a core portfolio, you would look at, rebalancing or readjusting it maybe once or twice a year. But a tactical portfolio, like Shweta mentioned, you must monitor carefully and rebalance it, as soon as the event is over. Don't keep it waiting. Okay, the next query comes to us from Kusum Jain, who writes to us from New Delhi. She wants to know, till when will the limit on foreign investments by mutual funds remain closed? She asked, should she remain invested in those funds which have such an exposure? What should she do? Okay, so this is a question that many people have asked and not received answers to. Anand, what would you recommend that Kusum do in the absence of this limit being further revised? Should they remain invested in funds which have an overseas exposure?
So Kusum, firstly, I wish I knew the answer when the limit will be extended. I think everyone is hoping that it gets extended. So the rule is that, SEBI has an overall limit of $7 billion for the overall mutual fund industry to invest in stocks directly overseas. And there's an additional 1 billion limit of 1 billion limit for mutual funds investing in ETFs abroad. So sometime back, we came closer to that limit. As a result, SEBI came back and said, okay, you can't invest anymore. Now, subsequently, some redemptions happened. And now, there is a new law that you can take fresh investments to the tune of the redemption in those schemes. However, on the ETF side, there is still some space and fresh investments can be made. So at this point of time, there are a few funds that are taking fresh investments like Kotak, NASDAQ, and a few others. On the second question, should you stay invested? I think, absolutely yes, depending on the size of your portfolio. We generally recommend a 10 to 15% investment in international funds. So depending on your goals and the percentage allocation in your current portfolio, I think you can continue to remain invested. However, depending on the scheme that you have, you may be restricted from fresh inflows at this point of time. So stay invested, and you can, if you still want that 15%, you can look to invest through Kotak, NASDAQ, and a couple of other funds.
Okay, on that note, we're going to take a very quick break. We have more queries lined up on the other side. Our two experts will stay on with us, so stay tuned. We'll be right back. Hi, welcome back. You're watching MF Corner. Anand Dalmia, co-founder and chief business officer at FISDOM, and Shweta Rajani, senior vice president and head of mutual fund at Anand Rathi Wealth, are with us. They're answering queries sent in by our viewers. And the next query comes to us from Kavya Ramkrishnan, who writes to us from Hyderabad. She says she's a 25-year-old professional who is, keen to start her investing journey. So she wants to know which are the right funds to invest in. And she says that she's also ready to start a SIP of 2,000 per month. So this is, a completely blank check to you, Shweta. How would you fill it?
Sure, Samira. Kavya, firstly, I want to congratulate you because you're just 25. You've probably started earning now and you're already thinking about investments. So thumbs up to you for that. Like I was explaining in one of the previous queries, that the first thing that you need to do is decide your objective. You've just started, so you definitely have a longer term horizon. So, let's say you're planning for 10 years, 15 years, or you may also have some short-term goal, 3 years down the line, maybe you want to purchase a car. So define what your objective is, and therefore how much money do you need at the end of that tenor? What's the return you're targeting? You, at your age, you should be ideally, having a larger risk appetite, but have these numbers in place. That's your step one and the most important step, because if that you've defined clearly, your investments, your implementation, all of that would just follow. So, get that in place. Second, I would say, is deciding your strategy to meet that return objective. So what asset allocation you want, what products or instruments you want comes in second. And then you just implement it and review it on a regular basis. So that's the approach that you should follow. You can have an equity heavy asset allocation. The instrument that you've chosen, again, is one of the, I would say, the best equity instruments because it's actively managed, professionally managed. So equity mutual funds is the right investment instrument for you. Now, if you're looking at it from a tax planning perspective, tax planning is one of the aspects of the overall financial management. So here are two of, I would say, good schemes which are good in terms of their return track record, the risk that they have, the fund managers that manage. Two funds that I would say is, you go in for a quant tax fund, or you can go in for a Kotak tax saver. That's from, like I mentioned, a purely ELSS perspective. If you have extra money that you're looking at doing from an SIP perspective, then a few other funds that you can look at can be an SBI small cap fund, a Kotak emerging, and an HDFC flexi cap fund for the equity component of your portfolio.
Okay, but all the very best, and thank you very much for seeking advice, before getting started rather than midway. Okay, Saugata Mukherjee has written to us from Silchar in Assam. He has an SIP in ICICI Prudential Nifty Next 50 direct growth plan of 2,000 per month, which has been going on now for over 2 years. He says he has not been very satisfied with the fund's performance and the returns, and wants to know if it is advisable now to switch to a different index fund with a similar risk profile and stop this SIP in the Nifty Next 50. Anand?
Yeah, so, I would say that over the last couple of years, we've seen that the large cap indices like the Nifty 50 or the Sensex have actually outperformed the indices beyond that, which is the smaller indices like the Next 50. Having said that, if you hold on for a longer period of time, you would see that, slightly higher returns on this front. We've had many discussions in the past around active funds versus passive funds and which one performs better. I would say, given that you're not very happy with the performance at this point of time, maybe you should look to split your investments, whatever amount you have, equally between the Next 50 that you have and an actively managed fund. You can probably choose a multi-cap or a flexi-cap fund so that you can get the best of the both. So that would be my suggestion.
Okay. Up next, we have a query from Mumbai. Ashok Khurana has written in, and he wants to know how to make the choice of whether to invest in a FMP, or fixed maturity product, or a target maturity fund, TMF. So basically, if you have this kind of investment decision to make, how do you choose which of these is more suitable for you? Shweta?
Yes. So firstly, fixed maturity plan or target maturity fund, both are debt instruments which follow a hold to maturity strategy. So basically, both of them have a maturity date, right? Whether it is your FMP or your TMF. And now what I will do is I'll explain you the key differences between the two of them. Like I said, both of them are hold to maturity products. They're also called as roll down strategies. So basically what a fund manager is doing over here is he's buying certain papers and he's going to hold it down till the maturity. The benefit of these two categories is that if you are holding it till the maturity, then whatever is your indicative entry yield is what you would get, most likely at the end of the maturity. So if your indicative yield when you're starting off is 7%, a return closer to that 7% is what you can expect on the maturity. Now coming to the two key differences between them. A fixed maturity plan is close-ended in nature versus a target maturity fund which is open-ended. What I mean in that is that FMP, once you've invested, you cannot exit from it before maturity. Of course, they are listed in the secondary market, but you need to find a buyer, which could be difficult. A target maturity fund, on the other hand, is open-ended. So let's say you've invested today and 6 months later, 1 year later, you need liquidity for whatever purpose, then that liquidity option is available to you. That's one advantage of TMF over an FMP. The other advantage, or rather I would say the differentiation, is FMPs mostly have corporate papers. It could be AAA papers, it could be PSUs, but they're most of the time corporates. In target maturity funds, you'll get a better asset quality as well, because there are a lot of TMFs that come in with 100% central government paper or a mix of central government, state government papers, as well as combination of AAA. So you can get a better credit quality in a TMF than an FMP. So if I have to choose between the two, I would say because of these two advantages, you go for a target maturity fund rather than a fixed maturity plan.
Okay. The final query today comes in from Mehak Khanna. She has written in again from Bengaluru. She wants to know if Quant Mutual Fund is a consistently performing fund, and she further asked that how is it that they have managed to generate such returns when others could not? So basically the question is on whether or not, this performance is going to be consistent. Anand.
So, Mehak, you would have seen some time back Shweta recommending, quant tax fund. So, I would say last couple of years, quant has actually delivered very well. And one of the reasons probably has been that unlike most of the schemes which have a particular style, like a contra or a value investing style, quant actually does not have a style of investing. They're style agnostic. And we're very nimble in their approach. So they use quantitative models for all the investment decisions. As a result, you'll see that their portfolios generally have a very high churn. So, a normal fund will generally have a churn ratio of around 1, while, quant would have a churn ratio of 3 to 5, depending on the scheme. So in this upcycle, last 2 years, they've done phenomenally well. We like those funds. But, if the market were to move sideways, one needs to see the robustness of their, quant models. So I would say stay invested. They're doing well. A part of your allocation, they absolutely deserve it basis the performance for the last couple of years.
All right. Shweta, Anand, thank you very much to both of you for joining in today and answering the queries sent in by our viewers. With that, we're going to wind up on MF Corner. Thank you very, very much for watching. Do stay tuned. The team of Closing Bell joins you next.
Presented by